From the early days of the petroleum industry, the oil market has witnessed periods of wild and damaging price swings. The volatility over the years prompted various actors to intervene in the market to try and stabilise prices. In the late 1800s, it was John D. Rockefeller and his Standard Oil business that used its monopoly to control the market. Following the breakup of Standard Oil in the early 1900s, and after a period of increased price volatility, various US state regulators and international oil companies began to fashion supply controls. The Texas Railroad Commission and the Seven Sisters emerged from these efforts as the dominant force in the world oil order, and from the 1930s to as late as the 1960s, brought significant stability to the market through their actions. The 1970s saw another upheaval to this order and more volatility, with OPEC eventually prevailing as the new supply regulator. Not without its own trials and tribulations, the group has held the position of de facto market manager to this day and has been bolstered in more recent years through an expanded group known as OPEC+. The efforts by OPEC to balance supply with demand has drawn both criticism and support down through the years from market commentators. However, these views are often almost entirely based upon anecdotal evidence. The absence of systematic research on the topic prompted KAPSARC and other researchers to conduct a study on the effect of OPEC's actions. Published by the International Association of Energy Economics, the research concludes that OPEC's use of spare capacity has reduced oil price volatility significantly.
Breaking news from Wall Street in the wake of the coronavirus crisis. Stocks have stopped trading on Wall Street after a 7% drop.
Oil prices have turned negative.
The results of the study, along with the recent actions by OPEC Plus following COVID-19 induced oil market crisis, has shed more light on the benefits that market stabilisation efforts provide to the world economy.